Let's be clear right from the start. If you're down on silver right now, you're not alone. And you're not wrong. This market didn't move against fundamentals. It moved against positioning, leverage, and paper pressure. And today, I'm not here to talk about blame or regret. I'm here to talk about recovery, position repair, and what 2026 actually looks like from here, in real time. I'm recording this video specifically for you. If you've taken a loss because of the recent silver price crash and want to understand how to recover it, watch this video till the end. I'll share a clear roadmap for loss recovery in the current market. Drop a comment and tell me where you're watching from, what time it is, and how much loss you're facing due to silver. And before we continue, a quick note. Many of you watch these breakdowns but haven't subscribed yet. If you're finding value here, consider subscribing. It really helps support the channel. Let's start with the hardest part, because if we don't get this right, everything else collapses. If you're down on silver right now, the first instinct is to assume you were wrong. Wrong thesis, wrong timing, wrong market. But that conclusion is exactly what this phase of the cycle is designed to force you into. This loss did not come from silver failing. It came from the structure around silver breaking down under stress. Silver did not suddenly lose its industrial relevance. It did not lose its monetary history. It did not become abundant overnight. None of the long-term drivers that brought capital into silver in the first place have disappeared. In fact, most of them have intensified. What changed was not silver itself, but how silver is priced, traded, and liquidated in moments of financial pressure. What you just lived through was not a fundamentals-driven sell-off. It was a balance sheet-driven liquidation. That distinction matters more than almost anything else in market recovery. When prices fall because demand collapses, recoveries are slow and uncertain. When prices fall because leverage is forced out of the system, recoveries tend to be violent, uneven, and deeply misunderstood at the time they begin. In real time, what happened was simple but brutal. Large funds, traders, and institutions were positioned for upside. When volatility hit, margin requirements rose, correlations spiked, and risk desks did what they always do under pressure. They sold what they could, not what they wanted to. Silver, being liquid, tradable, and heavily represented in paper form, became a source of cash. That selling had nothing to do with silver's real value. It had everything to do with survival mechanics inside the financial system. This is where most investors misinterpret the signal. They see the price fall and assume the market is telling them something about silver. But the market wasn't speaking about silver at all. It was screaming about leverage, counterparty risk, and liquidity stress. Silver was the messenger, not the message. And here's the critical part. When price falls for structural reasons, it does not invalidate the thesis. It actually stress tests it. The question is not whether silver went down. The question is whether physical availability, strategic demand, and long-term utility collapsed alongside it. And the answer, right now, is no. In fact, this is where the divergence begins. Paper prices can fall rapidly because they represent claims, not objects. They can be sold in size without regard to delivery, logistics, or real-world scarcity. Physical markets don't work that way. They move slower, they resist, they reveal friction, and friction is information. If silver had truly failed, you would see it everywhere at once. You would see it in inventory builds, collapsing premiums, desperate sellers, and vanishing demand. That's not what's happening. What you're seeing instead is price discovery being temporarily hijacked by forced selling in the most abstract layer of the market. That distinction is why this loss feels confusing. Your thesis told you one thing. Your screen told you another. And when those two conflict, emotion fills the gap. But markets don't reward emotional conclusions. They reward structural understanding. This phase is designed to shake out participants who confuse volatility with invalidation. It is designed to make long-term positioning feel stupid right before it becomes obvious. And it always feels personal when you're inside it. But the market isn't judging your intelligence. It's testing your time horizon. So understand this clearly. You are not down because silver stopped working. You are down because the financial system periodically eats its own leverage. Silver just happened to be standing nearby when it did. Once you see that, recovery stops being about hoping you're right and starts being about positioning for what happens after forced selling ends. And that's where the real plan for 2026 begins. The second thing you have to do, especially if you're trying to recover a loss in silver, is break your dependency on the screen price. Because right now, the number you're staring at is not the truth. It's a reference point. And in moments like this, confusing the two can cost you both money and conviction. The price you see flashing on your chart is the most fragile layer of the silver market. It is the easiest part to move, the fastest part to liquidate, and the least connected to the physical metal itself. Yet psychologically, it has the most power. It feels authoritative. It feels final. And when it moves against you, hard and fast, it can override months or years of disciplined thinking in a matter of minutes. What you're watching in real time is paper price discovery under stress. Futures contracts, options, ETFs, and synthetic exposure dominate the volume, especially during volatility events. These instruments were never designed to reflect scarcity or long-term value. They were designed for liquidity, hedging, and speculation. When stress hits the system, they behave exactly as designed, by transmitting pressure, not truth. That's why price can fall even as real-world demand holds steady or rises. Paper silver can be created, sold, and extinguished in volumes that have no relationship to mine output, refinery capacity, or delivery constraints. A single large fund de-risking can overwhelm weeks of physical demand in seconds. That doesn't mean silver is suddenly worth less. It means claims on silver are being repriced to restore balance inside the financial system. This is where most investors lose the plot. They assume price equals reality. But in silver especially, price often lags reality, or outright contradicts it. The real signals are quieter and slower. They show up in premiums, availability, delivery delays, and regional price differences. They show up in who can source metal easily and who can't. They show up in what happens when stress lasts longer than expected. In moments like this, physical markets don't collapse instantly. They resist, they stretch, they adapt. Sellers don't rush in at once. Buyers don't disappear overnight. Instead, friction builds, and friction is the tell. When the paper price drops, but the effort required to acquire real silver doesn't, you're seeing a divergence that cannot last forever. This is why anchoring emotionally to the screen price is so dangerous. It trains you to react to the most distorted signal in the system. It pushes you to sell exhaustion instead of risk. It convinces you that something is wrong when what's actually happening is a transfer, from weak hands to strong, from leveraged exposure to patient positioning. The market wants you to believe that the chart is the whole story because charts move people. But recovery doesn't come from watching price, it comes from understanding structure. And the structure of silver pricing is layered. Paper dominates headlines. Physical dictates outcomes. As we move toward 2026, this distinction becomes even more important. The more unstable the financial environment becomes, the wider the gap between paper signals and physical reality tends to grow. Stress doesn't eliminate demand for real assets. It changes how and where that demand expresses itself, often quietly, often unevenly, often in ways the chart won't show you until much later. So, if you're trying to recover a loss, the discipline is this. Stop letting the most volatile layer of the market dictate your emotional state. Use price as information, not judgment. Let it tell you when leverage is being flushed, when pressure is peaking, and when forced sellers are active, but don't let it define the value of what you hold. Because when paper selling finally exhausts itself, price doesn't rise politely, it snaps. And the people who recover are never the ones who trusted the screen the most. They're the ones who understood what the screen was lying about. That's the shift. And without it, no recovery plan survives first contact with volatility. At this stage, it's important to say something most people don't want to hear, but need to. If you're sitting on a loss in silver right now, that loss is not a verdict on your intelligence or your conviction. It's a positioning problem. And positioning problems can be fixed. Timing failures usually can't. Markets rarely punish people for being right too early. They punish people for being too rigid while they wait. Silver is one of the most volatile markets in the financial system, not because it lacks value, but because it sits at the intersection of industry, money, and speculation. That combination guarantees turbulence. If your exposure wasn't built to survive turbulence, the market will find it. It always does. Most drawdowns in silver don't come from price alone. They come from how exposure is structured. Leverage compresses time. It forces decisions on the market's schedule, not yours. Even modest leverage becomes lethal when volatility spikes, correlations rise, and liquidity dries up all at once. In those moments, the market doesn't care about long-term conviction. It cares about margin, risk limits, and immediate solvency. That's why so many losses feel unfair. You can be directionally right and still be forced out. The price doesn't have to go to zero, it just has to go far enough, fast enough to trigger liquidation. When that happens, the loss isn't a judgment on the thesis. It's the mechanical consequence of exposure that couldn't wait. Recovery begins when you stop thinking in terms of winning the next move and start thinking in terms of staying power. Time is the most underappreciated asset in markets. The ability to remain positioned while others are forced to exit is where asymmetry is created. but time only works for you if your position allows it. This is where mindset shifts from prediction to architecture. Instead of asking where silver goes next, the more important question becomes whether your exposure can survive if it doesn't go there immediately. Volatility isn't an anomaly in silver, it's the baseline. Any position that assumes smooth movement is already vulnerable. The market environment heading into 2026 will not reward speed or bravado, it will reward flexibility. That means being able to adjust, rebalance, and absorb price swings without being pushed into irreversible decisions. It means reducing fragility before trying to capture upside. Fragile positions break at the worst possible moment, right before the move they were built for. There's also a psychological element that can't be ignored. Loss creates urgency. Urgency creates mistakes. When people feel behind, they reach, they overcorrect, they try to make it back quickly. That behavior transfers capital from the impatient to the disciplined every single cycle. Recovery isn't about getting even, it's about getting aligned. Once you recognize that your loss came from how you were positioned, not what you believed in, something important happens. You stop fighting the market and start working with it. You stop needing immediate validation. You stop mistaking pressure for failure. Silver doesn't move in straight lines, and it never has. But it does reward those who can stay in the trade long enough for structure to reassert itself. Fix the position, extend the horizon, and let volatility become something you endure, not something that defines you. That's how losses turn into setups. And that's how 2026 becomes a recovery year instead of a regret. One of the biggest mistakes investors make after taking a loss is assuming recovery means going back the way things were. That mindset is especially dangerous in silver. The market you're moving into in 2026 is not the market you came from. Expecting a straight line rebound isn't just unrealistic. It sets you up to fail twice. Silver doesn't recover cleanly because silver doesn't break cleanly. When price is suppressed by structural forces, it doesn't unwind politely. It snaps, stalls, retraces, and reasserts itself in waves. That's not dysfunction. That's how repricing works in a market that has been artificially compressed for years. The volatility ahead isn't a sign that silver is unreliable. It's a sign that the system pricing it is unstable. This is why waiting for confirmation often backfires. By the time silver looks safe, it's already moved. And by the time the move feels real, it's usually extended. The recovery phase is uncomfortable by design. It happens when confidence is low, narratives are fractured, and price action feels erratic. That's not a bug, it's the filter. In 2026, silver is unlikely to deliver a smooth trend that rewards passive optimism. Instead, it will likely produce sharp advances, followed by sudden pullbacks that feel like betrayal. These resets are not reversals, they are stress tests. They exist to see who understands the difference between volatility and failure. Most people don't. They interpret every pullback as proof they were wrong, and every surge as something to chase. That behavior creates a cycle of late entries and early exits. It leaves investors exhausted, underexposed, and emotionally detached right before the most important moves. A repricing year doesn't reward certainty. It rewards preparedness. It favors those who can operate without needing constant reinforcement from the chart. It favors those who understand that instability is the pathway, not the obstacle. There's also a timing illusion that needs to be addressed. Recovery does not arrive on schedule. It doesn't align with personal break-even points or emotional readiness. Markets don't care where you bought. They care where pressure is released. When that release comes, it comes fast, and it rarely asks permission. That's why the real risk in 2026 isn't missing upside. It's being shaken out during the process of repricing. It's mistaking volatility for invalidation and stepping aside just as the market transitions from suppression to expression. This phase requires a different relationship with price. Instead of looking for smoothness, you look for behavior. Instead of expecting consistency, you watch for signs of strain in the system that's been holding price down. Every violent move is information. Every retracement is a negotiation between old structures and new realities. Repricing years are uncomfortable because they expose illusion. They reveal how much of the prior price was managed, deferred, or distorted. When those controls loosen, the market doesn't glide, it recalibrates. If you understand that now, you stop waiting for a perfect chart. You stop expecting validation before committing to a plan. You accept that the path back isn't a straight line, but a sequence of tests designed to eliminate anyone who needs one. Silver's recovery won't look obvious while it's happening. It never does. It will only look inevitable after it's over. The people who recover in 2026 won't be the ones who predicted every move. They'll be the ones who stayed positioned while the market figured itself out. By the time you reach this point, the recovery conversation has to shift from theory to execution. Understanding why silver fell, why paper price lies, and why positioning matters only helps if it leads to action. This is where most people freeze. They know something needs to change, but they're afraid that acting means admitting they were wrong. In reality, refusing to adapt is the only real mistake left. The recovery plan for silver isn't about one dramatic move. It's about regaining control. Control over exposure, control over time, and control over emotional decision-making. Loss feels chaotic because it strips those away. The first objective is to rebuild them deliberately. Recovery starts by redefining what progress actually looks like. If your only metric is getting back to your entry price, every market move becomes personal. That mindset keeps you reactive. The healthier frame is asking whether your position is now stronger, more durable, and better aligned with the environment ahead than the one that failed under stress. If the answer is yes, you're already recovering, even if the price hasn't reflected it yet. This phase requires you to respect volatility instead of fearing it. Volatility isn't your enemy anymore. It's a tool. It creates opportunity to adjust exposure, rebalance risk, and gradually improve your average positioning without betting everything on perfect timing. The goal isn't to nail the bottom. It's to ensure that when repricing happens, you're present and intact. A real recovery plan also accepts that markets move in phases. There will be periods where nothing seems to work, where price chops sideways or drifts lower without resolution. That's not failure, that's digestion. This is where patience stops being a virtue and becomes a weapon. Most people can't sit through uncertainty without doing something destructive. That's why simply doing less at the right time can outperform constant action. Another critical part of recovery is separating conviction from stubbornness. Conviction means you understand the long-term role silver plays in a fragile financial system. Stubbornness means refusing to acknowledge that how you express that belief may need to evolve. The market doesn't reward static thinking. It rewards adaptation anchored to a consistent thesis. As 2026 approaches, flexibility becomes more valuable than prediction. The environment ahead will likely include sudden shifts in liquidity, policy reactions, and sentiment. A recovery plan that assumes calm conditions will break. One that assumes disorder and prepares for it can thrive. Most importantly, recovery demands emotional discipline. Loss creates a desire for speed. Speed is how mistakes compound. The market will offer moments that feel like chances to get it all back. Those moments are usually traps. Sustainable recovery is slower, quieter, and often boring. It doesn't feel heroic. It feels controlled. When you strip it down, the plan is simple. Reduce fragility, extend your timeline, use volatility to improve position quality rather than chase relief. Let the market come to you instead of forcing resolution. By the time silver begins to reprice in earnest, the work will already be done. Recovery doesn't happen at the top of the move. It happens beforehand, in the decisions that no one else sees and few have the patience to make. That's how losses are repaired. Not with hope, but with structure. By the time you reach this stage, the market is no longer testing your analysis. It's testing you. This is where most people quietly exit, not because they were proven wrong, but because they're exhausted. Loss wears people down in ways charts never show. It drains patience, confidence, and trust in your own judgment. And that's exactly why this phase exists. Silver doesn't break people with one dramatic collapse. It breaks them with time. Long stretches of frustration followed by sudden moves that punish the unprepared. The market knows most participants can tolerate being wrong for a moment, but very few can tolerate being uncomfortable for long. Endurance, not insight, is the rare asset here. This is where the psychological edge separates itself from everything else. Most investors believe success comes from being early. In reality, it comes from staying through noise, staying through boredom, staying through the moment when nothing seems to validate the original decision. That's when the crowd thins out, and that thinning is what makes the eventual repricing so powerful. Capitulation rarely feels dramatic to the person experiencing it. It feels reasonable. It feels like relief. People tell themselves they'll re-enter later, when things are clearer. But clarity in markets is expensive. By the time a move feels obvious, the asymmetry is gone. The emotional low that pushes people out is often the same moment that structural conditions are quietly improving. What makes this especially difficult in silver is that validation arrives late. Silver can be right long before it is rewarded. That delay creates doubt, and doubt creates distance. People disconnect emotionally before they disconnect financially. By the time they sell, they've already given up internally. The edge, then, is not blind optimism. It's emotional discipline. It's the ability to hold a position without constantly interrogating it for reassurance. It's understanding that markets do not pay for comfort. They pay for discomfort that is survived with intent. This doesn't mean ignoring risk or refusing to adapt. It means distinguishing between real danger and psychological pressure. Most selling near lows is not driven by new information. It's driven by fatigue. The market exploits that fatigue because it's predictable. Human behavior doesn't change, even when technology does. As 2026 approaches, the pressure will intensify before it releases. That's how these cycles resolve. The final test is rarely about price. It's about belief. Not belief in silver, but belief in your ability to stay rational when the environment is designed to destabilize you. If you can do that, something shifts. You stop needing the market to agree with you immediately. You stop chasing narratives. You stop flinching at every move. That calm doesn't come from confidence. It comes from acceptance. And here's the truth most people never hear. Silver doesn't reward the smartest participants. It rewards the last committed ones, the ones who didn't need to be right on time, only right in structure. When repricing finally comes, it will feel sudden. It will feel obvious in hindsight. And it will belong to those who endured the longest without breaking. That's the psychological edge. And it's the rarest asset in the market.